Hi, and welcome to this week's Symax Fintech Weekly Market Insight. First, our disclaimer. So, trading involves the risk of loss of capital. It's not suitable for everyone. As I always say, hopefully it is for you. Many companies provide leverage. You should just be aware that you can lose substantially more than your initial investment. Views, opinions, information contained in this are just purely for educational purposes. We're not encouraging you to trade or invest. That has to be your decision. Before you do that and make that decision, you should carefully consider your risks, your financial situation, your level of experience, definitely, and risk appetite. And of course, you should only risk capital you're prepared and, more importantly, you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you start to risk your capital. Okay, so I'd like to apologise that we didn't have one of these last week. I had an eye infection, which made it difficult for me to sort of focus on the analysis, etc. So apologies, but we're back this week. And what a fun week it was last week. Market seesawed on data. It was pretty mixed, and comments during the week as well. Just sort of confused the in markets really and investors. So the market seesawed, they were rallying, and then towards the end of the week reversed again, so pretty much finished the week unchanged. But probably the only one that really didn't was oil, and that had a big sell-off. That actually at one stage on Friday went below $78 and closed just above 80. And the Dixie went below 106 as well. So that's the dollar index for those of you that are not familiar with that. That's a basket of currencies against the dollar. US surprised with lower PPI, which encouraged investors. It was still 8% with core at 6.7% though. Investors are getting excited. Let's go in and buy stocks when they hear all of this. But the point is, it's so far above the Fed's desired level of 2%. Well, most central banks, to be honest with you, they all like 2%. And of course, it's way above that, so you can't expect anything to change quickly. Retail sales in the US were a little bit better. In the UK, they were better too. Canada CPI dropped to 5.8%. Now, US capacity utilization. Now, that came in at 79.9. Now, above 80 is growth. Above 84 or at 84, it's like maximum. So it just shows that sort of output is dropping slightly. So that indicates that demand is dropping slightly. And of course, on top of that, we're seeing house prices are dropping. But you've got to expect that. You can see some people's mortgages have doubled over this year. And of course, it's more expensive to buy a house, and it's more expensive to finance buying that house. So I would expect bigger drops in house prices over the next year for sure, especially in the UK, by the way. So the UK budget was bad, with stealth taxes leaving households and small businesses worse off. The Treasury is trying to find £55 billion. They gave a little bit to the very, very needy, which is good to see. But they've taken it off of course, as usual, the 99%. Saying that, earnings still increased in the UK, as did retail sales. CPI came in at 11.1, 40-year highs. And that is sort of worrying. Part of it was because of the fact that the energy price cap has moved up. It's going to move up again in April next year, though. So are we going to see yet another spike in inflation then? The government keeps lifting this cap up, so we're paying more and more for our electricity and gas. And of course, that is going to impact households and sort of their money management, what they can afford to buy. I would say that in the UK, we're always that little bit more sort of ahead. I don't mean that in a big-headed way. I mean, when it comes to shopping, we're always probably a season ahead, in fact, when it comes to what's in the shops. And of course, they're already massively Christmasified, so everyone's out buying their Christmas stuff. The shops are packed. I live in the UK, so I'm seeing that for myself. So I'm just passing that on to you. So, although data's there, inflation may stay up because people are prepared to spend because they love Christmas. Republicans in the US regain control of Congress, although it is only a small majority. And Trump announced that he would run in 2024. Yeah, it's okay, but he didn't do as well. The Republicans didn't do as well as everybody expected them to do. So, I'm maybe just a 5–10% surprised that he's decided to run again. Let's see what happens as we go forward. Investors took all the data as good news until central bankers repeated their determination to beat inflation. Japan and China had weaker data. Japan GDP was negative. So, moving on to this week, Trump is back on Twitter, so that's going to be interesting. I'm sure it's either going to be very quiet or very, very busy. Probably the latter. We've got a few central bank speakers this week. And then, there's data out, nothing major, but when we look at it, in the US, we've got durable goods, PMI, so manufacturing, Michigan consumer sentiment. Consumer sentiment makes up a big part of what's going on. The more confident and stronger feeling we've got about our earning capabilities, the more we'll spend. The less we'll spend. New home sales are coming out, and again, I wouldn't expect them to be sort of great. Now, we've got the FOMC minutes coming out, which should be important. So just to see what was discussed, and we know the discussions, all the inflation, but everything around that for any forward guidance that we can take from it. And then on Thursday, it's US Thanksgiving. Now, with that happening, a lot of Americans use that because that's a major day for them as a long weekend. So, you could see lower volumes after Wednesday, but you could see increased volatility. You've been warned. In the UK, we've got public sector borrowing. Again, something we don't really bother about too much in the past, but again, because of the amount of debt that the UK government's taking on, and the Tories have just sort of, well, what can I say about them? They've been a disaster this year, keep changing the Prime Minister and such like. But we've got one for the moment. Let's see how long he can last. And we've got PMI out as well. And then moving on to the EU. We've just got consumer confidence again. As consumers, we account for anywhere between 60–70% of the economy. So it's important how we do feel about our earning abilities. The households, not just the individuals. And again, PMIs are out, so there's PMI as well. And then moving on, there's also German PPI coming out, PMI and GDP. Then moving on to China, we've got their rate decision. I wouldn't expect any change there. They've still got lots of problems with COVID. Sales are not great, etc. And then moving on to Canada, there we've got retail sales as well, so we can see, if people are spending. Moving on to New Zealand, a rate decision there, so that'd be interesting, see how much they hike by. And retail sales as well. So just remember this week, the first half of the week is going to possibly be where all the activity is. The last couple of days of the week with the US on holidays, sure, there'll be stuff going on, but you just want to be a little bit careful because you're going to see lower volumes, which can increase volatility. As usual, moving on to the macro outlook. So inflation, it's showing signs of peaking, certainly in some countries, even starting to drop, but it's slow. And, this will continue to worry bankers, the fact that it is so slow. Central banks are determined to regain control of inflation, and that is regardless of the cost. And if that means recession, so be it. And they're just going to continue with their rate increases, although I would say possibly at a slower pace. But as I keep saying, they're going to hold those rates up for longer, well past the middle of 2023, even possibly into 2024. I would expect to see rates stay up. Uh, recessions, yeah. For me, it's not a case of if there's going to be recessions. It's just a case of when they're going to hit and how deep they're going to be, or how shallow. And some of that's going to depend on energy. It's going to depend on food prices. What's going on there, and any sort of external geopolitical drivers, really. As I mentioned earlier, I still expect house prices to drop. And in the UK, it's forecast they could drop even up to 20% as our recession will be bad, potentially deep and long. Supply chains have improved, but COVID cases are on the increase again. There's so many Omicron variations. Now, China's sending mixed signals when it comes to lockdowns. It wants to ease this zero COVID policy, but how can they when cases are increasing at such a rapid rate? Ukraine, Russia invasion there, ninth month, soon be the 10th month, continues. Ukraine continues to make some progress, though, at regaining ground. However, it is coming at a cost as Russia's increased their bombing. It's sort of a bit more widespread. They are focusing on utilities such as power and water, though, to try and cripple the country. Energy prices are dropping. Oil's down, gas is down. European weather at the moment is reasonable. It is a little bit colder, but it's not freezing. So, people will be deterred from using their heating or using their heating as much as they usually would otherwise. But of course, weather can change very quickly. I mean, look at New York, they got 6 foot of snow. Earnings pressure remains at the moment, but to be honest, I do expect this to drop and suddenly, and there will be job losses, and then the job losses will pick up pace. I mean, just look at what's been happening in the tech sector.